I'm Alex Black, Head of Innovative Accounts here at Ad Valorem, and today we're going to take you through what is a balance sheet. A balance sheet is crucial to understand for anyone looking at investing in a business or trying to assess whether they're on track to meet their own targets and goals. In this guide, we're going to run through the key elements of a balance sheet, how to look at them, and what a strong versus a weak balance sheet looks like. Let's start with the basics. The balance sheet is one of two primary statements that make up your accounts at the year end alongside the profit and loss. It shows a snapshot of the company's position at a moment in time, typically the end of the financial year. It is made up of three core elements: your assets, your liabilities, and equity. Assets are all the things the company owns, such as its stock, its cash, and any property or equipment. Liabilities are all the things the company owes out, such as any loans, any suppliers you owe money to, or any overdrafts that you may have. And equity is a summary of the shareholders' equity, which is basically everything that the owners of the business own after all the assets are sold and all the liabilities are paid back. In general, your assets minus your liabilities must equal your equity, and everything must balance, hence the name. Elements of a balance sheet. Let's break those sections down into their core elements. Each section is broken down into two subsections. Assets becomes current and non-current assets. Current assets is any asset turned into cash or expected to be used within 12 months, such as cash at bank, inventory, or amounts owed by customers. Non-current assets are any of those assets not turned into cash or expected to be used within the first 12 months, such as your property and equipment, any long-term investments you might hold. Likewise, liabilities are broken down into current liabilities and non-current liabilities. Again, your current liabilities are any of those expected to be settled within the first 12 months, and non-current, any of those will exceed it. Current liabilities may include suppliers that you owe money to, any short-term debts that you might have or overdrafts, and long-term liabilities will be any loans due back greater than 1 year. Equity is broken down into two sections: share capital and retained earnings. Share capital is the funds the owners initially invest to buy into the business, and retained earnings is the accumulation of any profits and loss since the business started trading, minus any dividends or distributions. What makes a strong balance sheet? Now that we understand the different elements of a balance sheet, let's discuss what a strong balance sheet looks like versus a weak balance sheet. Now, this is a bone of contention, with many advisors giving different metrics or ratios that they swear by. Ultimately, this will depend on the company, its market, its strategy for growth, and the risk profile of its owners. But fundamentally, what you want to see is strong liquidity. Can the company's current assets meet its current liabilities? This is a good indication that the company can meet its ongoing obligations without relying on future revenues. Next, you've got positive equity. Ultimately, can the company's total assets meet its total liabilities, indicating that if push came to shove, the company can meet all of its obligations straight away. And finally, you've got stable and growing equity. Is the company's retained earnings stable or growing year on year, indicating that the company is in a profit-making position and will continue to reinvest in itself? Weak balance sheet warning signs. Here are some of the warning signs of a weak balance sheet. You've got low liquidity. If a company has insufficient current assets to meet its current liabilities, it indicates it can't meet its obligations without injecting additional revenue or assets into the business. Negative equity. Similarly, if a company's total assets can't cover its total liabilities, it indicates if push comes to shove, it won't be able to pay down all of its obligations. And finally, declining equity. If a company's retained earnings is continuously declining, it indicates losses and potential financial issues. In conclusion, understanding how to read a balance sheet is an essential skill for business owners, investors, and creditors alike. A strong balance sheet will indicate strength and financial stability, while a weak balance sheet will indicate financial distress. Always remember to consider the industry and the context of the business, and if you're unsure, consult an accountant. Thank you very much for watching this video. If you found it helpful, please like and subscribe so you can get more of our content, such as our written guide, What is a Balance Sheet? And as always, remember to do your due diligence before making any financial decisions.